Hello everyone, welcome back to another video. Today we're going to be talking about earnouts in M&A transactions. And if this is your first time watching one of our videos on Finance Kid, just as a background, I am a Canadian investment banker focused on the middle and lower middle market space within Canada, selling businesses. So I do this in my day-to-day, and I'm trying to share some of these things with you as well as the viewers. So this video is really geared towards both buyers and sellers, just to provide a complete overview of what an earnout is, what are the common terms in the marketplace today, what are some of the risks, and then also going through some of the past case studies from past transactions that our firm has worked on. So let's jump into it. An earnout is a type of seller financing used in M&A to bridge the valuation gap between the seller's expectations of future performance versus the buyer's view of risk. And so what that means is that a portion of the purchase price is going to be deferred over time, subject to future financial performance. And unlike a second mortgage or a vendor note, a VTB, which is commonly referred to as, which is a loan between the seller and the buyer, which is fixed and not subject to performance, an earnout is subject to performance. And so there's typically a stigma associated with earnouts in M&A. Most sellers are very fearful. They hear all the stories from other business owners that have sold and taken an earnout and they haven't been able to realize on that earnout. But, to really boil it down, what an earnout is it's a prove it to me type structure. If you believe your business can continue to deliver at a high level, at the current levels or at the projected levels that you're selling off of, then a buyer will gladly pay you for that. But they are asking for you as a seller to share in the risk of that purchase price. So let's look at a classic example. So here, this company was historically doing $6 million in sales over the last 3 years. And then in the last year, in 2017, revenues jumped to $10 million. And then similarly, the EBITDA, or the profit that the business is being valued off of, was historically around $1 million, and it has also jumped to $2.5 million in EBITDA. Well, now the sellers decided to sell in 2017, so how do you value that business? Well, from the seller's point of view, you would want to sell off at 2.5 because the multiple is going to be higher, the valuation is ultimately going to be higher. But from the buyer's point of view, how do they know if you can continue to deliver on this number? And that's what an earnout essentially does. If you really want to sell off your last year earnings, there's not a lot of historical proof in terms of your past numbers, then maybe you accept an earnout and prove it out and show to the buyer that, yes, over the next couple of years, the business will continue to maintain, and therefore I will get paid for that higher valuation. Vice versa, from the buyer's point of view, say, for example, 2017 was an anomaly and eventually goes down in value back to maybe 6 or 7 million in sales. Well, then instead of overpaying for that business, that purchase price comes down to offset the future risk of the business coming down. So let's jump into some of the common terms. Usually an earnout is anywhere from about 10 to 60% of the purchase price. And I preface that by saying that's in the middle market and lower middle market. So typically I define that as anywhere from $1 million in purchase price up to about $100 million in purchase price, versus sometimes you'll hear, especially online, about the zero down type deals where you can essentially earn out the entire purchase price. That just doesn't happen in the middle market. Maybe a little bit relevant for more small business transactions, but not the case here. But the size of the earnout is ultimately correlated to the transition risk. So an easy way that I always present it to clients is the lower the transition risk, the higher the price and the lower the potential earnout, versus the higher the transition risk, usually you're going to get a lower price, and that buyer is probably going to ask you for an earnout to transition some of the risk. So when we talk about transition risk, what does that actually mean? What are some of the factors that influences whether transition risk is really high or really low? Well, the first one, and I referenced in the past example, is the change in EBITDA. So if there's a large substantial run-up, hockey stick growth in the revenues or the EBITDA, or maybe you're selling off of future projections where you're saying, no, I know I'm doing $2 million in sales today, but we're going to get a contract in the next 2 months and we're going to jump up to $10 million in sale. I want to get priced off of that $10 million. Well, that's a substantial change in the trajectory of the baseline EBITDA, which is used to value the business. So in that situation, the bigger the jump up or the decline sometimes in EBITDA, the higher the potential earnout in that purchase price. The second one is customers. Oftentimes, key customers, say for example, customer makes up 50% of the revenues or 40% of the revenues. Right now, we're selling a business where the number one customer makes up 72% of the revenues. Well, in that situation, if you lose that one customer, majority of the business value goes away. So a buyer is going to offer a price tied to that earnout and tied to that customer sticking around. Another one is technology innovation, where there are changes in products or services that you're introducing, and essentially the seller wants to capture the future value of that change, the new product line that's being introduced, but the buyer is saying, I don't know if that new product line is going to do well, so I will give you an earnout or a royalty tied to that future deal, assuming that it does well, you get paid, and if it doesn't and it falters, then you don't get paid for it. Another one is future contracts. So going back to that deal that I mentioned, so we're selling this business. It's a manufacturing company. 72% sales is the number one customer. The funny part is there's no earnout in the deal. Now, why would that be? Well, it's because there's actually contracts in place. So sometimes, yeah, there may be customer concentration, but if you have multi-year contracts, and in this situation, they have 3 to 4 year contracts that ensure that over the next couple of years, those volumes will be there, then the transition risk lowers, and therefore the earnout also lowers. So there's offsetting risks as well. And then another one is key employee risk. So say, for example, you have revenue generating employees. This is often the case with a professional service firm, like an architectural firm or a sales agency, where 2, 3, 4 employees really drive the profit of that business, and therefore they're a big contributor towards the value of the company. Well, from the buyer's point of view, they want to make sure that those employees are going to stick around and not use the business sale as an excuse to look for another job. So they would tie the earnout to the employee sticking around. And so that's another driver where, key employees actually increase the transition risk and therefore increase the earnout size. So moving over to other terms. So we talked about the size of the earnout, 10 to 60% usually in the middle market. And I would say, to be very honest with you, most of our transactions, if there is going to be an earnout, is anywhere from 10 to 30%. The 60% is usually when you're selling off hockey stick future projections and really trying to value maximize off of projections. But moving towards other terms. So the first one is the term. Most instances, an earnout is going to be anywhere from 1 to 3 years. The challenge is if you ask for more than 3 years of an earnout, from the seller's point of view, why would I take that deal? I could just own the business myself, because you're asking me to carry the risk of future performance for more than 3 years, and you're going to run that business for the next, say, for example, 5 years. Well, I'll just run it myself, own 100% of the P&L, and then also sell the business in the future. So usually with earnouts, it makes optimal sense for that 1, 2, sometimes 3 years. In most of our deals, I would say it's 1 to 2 years. That's the preference, because there it's short enough that, from the owner's point of view, it's still convenient enough to sell the business and exit and retire. But on the other side, there's enough time there's enough runway for that business to be transitioned and then also hit those targets. A 6-month earnout, for example, just wouldn't make logical sense. Now, the benchmark metric is essentially the milestones that you tie the earnout to. So say, for example, it's a $10 million deal. The earnout is 30% of the deal, so $3 million. And say, for example, the term of the earnout is 3 years. And we evenly pay for those 3 years across $3 million, $1 million each year. Well, in that situation, what are the milestones or the benchmarks that are used to essentially say, I will pay you that earnout payment of $1 million for that year or not? I would say the vast majority of earnouts are either tied to gross profit or EBITDA. From a seller's point of view, the preference should be gross profit, because EBITDA can be easily manipulated. Whereas a buyer's point of view, they're paying off of EBITDA. They want to make sure that the true profitability of that business moving forward is reflected in EBITDA, and therefore they're going to push for EBITDA. So there's a little bit of tension there, and that comes with negotiation and having a good investment banker in between the two parties. But I would say probably more than 50% of the time we land on a gross profit target for the earnout. Sometimes especially when it's more of a strategic buyer and they care less about your cost structure as a selling entity. They may just look at, I want to buy those customers, I want to buy those revenue producing employees. So the benchmark that really matters to me is only sales. So I'll pay you off of sales. But very rarely, that's only really in strategic buyer instances where we see, the earnout being tied to sales. But in that instance, that benchmark could be flat. You could say, I'm going to deliver $1 million in EBITDA for the next 3 years every single year, or it could be increasing. And oftentimes the worst case stories that we always hear from clients about, my brother sold to this person. Well, when we actually dig into the details, the first year earnout was $1 million, it jumps to 2, and then it jumps to 3. So how do you realistically grow a business that quickly? Sometimes earnouts are just set up to fail, especially from bad or aggressive buyers. Now, from a timing point of view, we usually see earnouts paid on an annual basis. And the reason why is that because you're tying it to a benchmark, you want that benchmark, usually EBITDA or gross profit, to be vetted by an external accountant. So usually you take the year-end numbers, you get them audited or review engaged by an external accounting firm, and then you provide those audited numbers to then calculate that final calculation to determine the earnout. If it's every quarter or every 6 months, well, then you're using internal numbers, and there may be the potential for dispute of whether those numbers are actually right or not. So usually it's an annual payment. And then lastly, from an interest rate point of view, sometimes what ends up happening is that you calculate the earnout, but then there's a payment delay. And the reality is you need some teeth to really encourage the buyer to pay the earnout. So what we usually see in our deals is that we have a payment interest rate overdue, chargeable interest rate. So what that means is that, say for example, every earnout is paid every single year. You have 90 days after year end to go through the process of calculating the earnout, getting the third-party accounting statements. After 90 days, any outstanding payment of that earnout is charged at an interest rate of 10% or sometimes 7%, sometimes 15%, depending on how punitive you want to make it. But ultimately, that puts the feet to the fire for the buyer to say, okay, let's get this resolved, and I write that check. Because you wouldn't want $1 million outstanding at 10%. That's quite high interest. So we always recommend from a seller point of view, make sure you put in an outstanding interest payment in the clause when their earnout is actually calculated after the milestone, that year-end calculation. So now let's actually jump into example. Let's look at different types of earnout structures, share my opinions on each of them, and then ultimately you can kind of choose which one works for your situation. So the first one is a very standard, the most basic structure is where you take a target, sales, gross margin, EBITDA, and the payment is made once that target is achieved. So it's really an all or nothing type deal. So as I said, in this situation, say for example, the business was doing about 700, 800,000 in EBITDA. It jumps up to 1.6 million in year 3. Now the buyer is asking the seller to hold back an earnout to say, fine, I'll pay you off the 1.6, but I need to see if you can maintain it. And so the target is therefore 1.6. So the target EBITDA payment here is 1.6, 1.6, 1.6 for all 3 years. The target is flat. And we always recommend that. Usually it's tough to ask a seller to hold back an earnout that is increasing in target year over year. So say, for example, this is 1.6, 1.7, 1.8, because the seller can influence the growth of the business. So you're essentially banking on the buyer's ability to grow the business, not just maintain it, which is really kind of a double whammy from a risk point of view. So really, if we ever are going to take a target from the seller point of view, especially as their advisor, I always look for that fixed, stable target throughout the 3 years. But in this situation, a standard deal, every year, if you hit it, boom. In this situation, in the first year, they generated 1.7, therefore it was above the target, you get paid. But the next year, they didn't hit it. So it missed the target, and therefore the payment wasn't made. And then in the third year, they hit the target, and the payment was made. But in this situation, because it's all or nothing and tied to each year, they really only made $2 million, 1 million here and 1 million here. That outstanding payment here was not paid. Now, to mitigate that all or nothing structure, and we almost never take the standard earnout, to be honest, because of that all or nothing risk, what we typically push for is to say, how about a multi-year average? So let's take this example where essentially if you maintain a target of $1.2 million over the next couple of years, and the average of the actual EBITDA over the next 3 years is higher than that, then you get paid. If it's lower than that, then you don't get paid. But in this situation, it really mitigates that risk of a high year and a low year and another high year, because really 2 out of the 3 years the business did really well. Maybe that third year there was a one-time event or something that happened. So really it gives the business the ability to catch up and truly deliver on a sustainable level over 3 years, i.e. the average. So that's why we kind of find that's a very fair structure. And then at the end, so the trade-off from the seller's point of view is they don't get the interim payments. They don't get the first payment in year one and the second payment in year two. They have to wait for it all the way to year three, but you're asking the buyer to essentially give you the chance to catch up for those slow years in lieu of, waiting for the payment a little bit longer. So buyers really like this structure because in this situation, they only have to write a check once, and it's at the end of the third year, which by then hopefully they've built the business or paid down debt and can write that check. Okay, so let's look at a prorated earnout scenario. And this is a preference for me because it's quite fair from both the buyer and the seller's point of view, and allows for a lot more openness in terms of potentially missing the target by just a little bit. So in the previous example, if the 3-year average is 1.19 instead of the target of 1.2, then that seller would miss out on the entire payment, which is really not the intention of an earnout, because realistically, if you miss it by only 100,000, is it really that much of a purchase price decline? So what we always recommend our sellers do is negotiate prorated earnouts instead, where even if you miss it just a little bit, there's a partial payment to at least recoup some of the purchase price that was earned. So there are different ways you can structure a prorated earnout. There's the percentage way, and there's also just the plain EBITDA multiplier way. So here, let's look at a percentage example. So say, for example, the earnout is $2 million over the next 4 years. That means $500,000 every year. The purchase price for the deal is 4 times, and the expectation is that the business is going to maintain a target gross margin of $3 million over the next 4 years. So every year, $500,000 gets paid. Now, so long as you deliver within 95% of the $3 million target, full payment is made, no questions asked. But if the gross margin comes in under that, meaning, say, for example, gross margin declines by 20%, then the percentage decline is multiplied by the purchase price, and that is applied against the earnout payment. But if the decline is more than either 25% or more, then 25% times 4 is 100%, which essentially eliminates the earnout period payment for that period. So let's put some numbers behind that. When you look at this historical earnings, business was doing 1.5, 1.8, it jumped up to 3.2. Buyer was like, okay, I'll pay you off of the most recent numbers, but I expect you to maintain 3. And in the first year, the business does exceed the target. It does 3.3. Therefore, it exceeds the 95% threshold, and a full $500,000 payment is made. In the second year, the business does $2.9 million in gross margin versus the target of 3, so it's within 96% of the target, which is above the 95% threshold. Therefore, the full payment of $500,000 is made. In the third year, though, gross margins continue to decline and now go down to 2.6. Now it's within 86% of target, so it's below the 95% threshold. Therefore, an adjustment has to be made. So gross margin is 13% lower, 2.6, versus the 3 million, multiplied by a purchase multiplier 4 gives us 53%. Therefore, only 46.8% is actually paid on that earnout value for that year. So 500,000 times 46.8% gives us 234,000. Therefore, a partial payment is made and prorated down as the performance declines. So instead of losing out entirely on a payment, the seller gets a little bit, because rightfully so, the business hasn't substantially declined, but at the same time, it has declined relative to expectations. In the last year, however, the business declines further, goes down to 2.2. In this situation now, margins are down 26%, which multiplied by 4 gives us more than 100%. So it zeroes out and no earnout payment is made in year 4. Now, in this situation, because it was a prorated structure, the seller probably would have earns more versus just a plain 3-year average bullet payment target. And that's the point of a prorated earnout. At least there's a chance to earn something instead of nothing. And that's why from a buyer point of view, you may have to pay a little bit more. But if you want to structure your earnout to make it more attractive for the seller so that they want to work with you, so that they can want to work with the concept of an earnout, prorated structures are an easy middle ground to consider. Now, the second one is a prorated earnout with an upside downside feature tied to an EBITDA multiplier. And that's why I put the gold star here. This is my favorite structure. And I'm using a past deal we did last year. But this is a really good structure in terms of a middle ground, especially in an auction process. So here the business was a manufacturing company. It was doing about $5 or $6 million, about $1 million in EBITDA. And then they get a contract. Earnings jumped to $10 million in sales and $1.8 million in EBITDA. Seller wanted to sell off that high. We found a buyer that was willing to pay off that high, but structure an earnout. So they paid about $8 million for the business, about mid-4 time multiple. And there was cash down to 5.5, with the balance being in a structured earnout of 2.5 million. Now that earnout would be paid at the end of year 3 in a bullet payment. And we took a 3-year average target of the historical last year earnings of 1.8 to say, prove it to me that you can continue to do that. But the structure of the earnout was that the difference between the actual 3-year average versus the target was multiplied by 4 to allow for both an upside increase in the earnout or a decrease in prorated down. With the importance of an upside feature, however, from a buyer point of view, is you always have to have an earnout cap or a ceiling, because you don't want it on no ceiling, because say, for example, they absolutely hit it out of the park and you got to write a massive check. You may not be able to price that into your model. So it's important to limit your upside and also set a floor on the downside. So in this situation, the earnout cap on the top end was 2.1. So they would pay the seller an additional purchase price if the business exceeded the target of 1.8 up to 2.1, and vice versa. They would pay an earnout all the way down to about 1.4. But if the business did, say for example, 1.3 over the next 3 years, no earnout was paid and it was fully lost. So let's put some numbers to that. So if you look on the left side, just start here. So here is essentially, the scenario analysis based on the different types of EBITDA averages. So if the business, for example, does what it is expected to do over the next 3 years, which is 1.8, then the full 2.5 million is paid and the purchase price is 4.4 times. But say, for example, the business knocks it out of the park and does 2.1 million over the next 3 years in EBITDA. Well, the excess between the target and the actual average is 300,000. Multiplied by 4 gives us an additional 1.2 million in increased purchase price, which is added to the 2.5 million earnout to give us a total purchase price of 9.2. That allows for that upside feature to share more with the seller. But from the buyer's point of view, you may be thinking, well, I don't want to pay more. Why am I exposing myself to that? Well, the reality is, if the business did 2.1 million in average EBITDA, then really the implied multiple on that 9.2 relative to the 2.1 is still what your purchase multiple was in the same range, about 4.38 times. And then vice versa, as it's prorated down, say, for example, the business does 1.4, then the delta is 400,000 down, times 4 is 1.6 down, adjusted down. So 1.6 off the 2.5 gives us 900,000 in remaining earnout payment. So the total purchase price for the business, when delivered only 1.4 million during the buyer's ownership period, was really only 4.5 times as well, because it was 6.4 million total purchase price. So it's quite fair from an upside downside point of view, so long as you tie it to the EBITDA multiple. Okay. So here's another alternative. This one I've seen more and more often, especially in wobbly market times, because typically sellers are afraid of waiting 3 years with no sort of payment to get one big check at the end of the day. So sometimes what they'll ask is, I want an interest payment. I'm extending you money for X amount of years. That's essentially like a loan. So give me some sort of interest rate tied to that. And then as well, I want some sort of amortization or interim payment, so I know that it's not like you have to come up with all this money at the end. You can fund some of it throughout the process. I want amortization. And so really this is almost like a quasi vendor note / earnout, because there's an adjustable portion based on performance, but at the same time, there's interest and principal payments that are made along the way. So let's look at an actual example. So in this situation, the earnout was 1.5 million over the next 4 years. And the target gross margin expected for the business was $3 million. Now, if they delivered the 3, then they'd get the full expected earnout payment and interest payment in that period. But if they delivered less than the 3, then it was dollar for dollar reduced down to all the way 2.5 million. So the ceiling is obviously the target, and then the floor is 2.5. And the reason why it's 2.5 is it's essentially dollar for dollar. So if I'm going to pay you 500,000 in earnout period per period, then really if it goes down by 500,000 dollar for dollar, it zeroes out to zero. Now, every year I'm also going to pay you 5% on top of your earnout payment, but I ask that in the first year it's going to be interest only, and then in years 2, 3, and 4, I expect the earnout payment. So I'm going to pay you the 500,000 over the remaining 3 years, assuming you maintain 300,000 or 3 million in gross margin, or I'll pay you partially if gross margin in years 2, 3, and 4 land between 2.5 and 3 million. So looking at some numbers, same thing, same business, 1.5, 1.8 up to 3.2. The target is 3, and in the first year, the business still outperforms the target of 3.3. Therefore, the business has earned the right to the seller has earned the right to charge the interest rate, but no earnout payment is made in that first year because it's interest only. So 5% times the outstanding principal balance of the earnout of 1.5 is 75,000. So the seller in the first year receives interest of 75,000. So they're happy. I've extended you money, I've gotten something back. In the second year, the business delivers just under the gross margin target. So the earnout is reduced dollar for dollar by what the target is missed by, which is 100,000. So instead of a 500,000 earnout, it's reduced by 100,000. So the earnout is 400,000 that's paid in that year, with the balance of the 75,000, which is really the 5% that was paid for that period as well, because the outstanding principal throughout the year was 1.5. But now, because I've paid out the 400,000, for the next year, my outstanding principal is down to 1.1 million. So my 5% interest is now based on the 1.1 instead of the 1.5 in years 1 and 2. So in year 3, you'll see here the interest rate is 55,000 instead of 75 because it's 5% times 1.1 million. Now in year 3, the gross margin goes down further to 2.6. So now it's a 400,000 decline. So dollar for dollar, the earnout gets reduced by 400,000, so only 100,000 is paid. So the earnout now, the payments have declined. The interest rate is still at 5% because at least they're delivering within the band. And in the last year, though, business continues to decline down to 2.2. That's way below the $500,000 band. So the earnout zeroes out, no earnout is paid, and therefore the interest minimum threshold of 2.5 as well is not met. Therefore, no interest is paid, and the outstanding 1 million is completely lost and forgiven. So in this situation, even though the business declined, the seller was able to receive some interest along the way, receive 2 earnout payments when the business actually delivered, but then ultimately the other million, because they couldn't deliver on the gross margin targets, was not paid out. So this is another structure where, again, a little bit more risk for both the buyer and the seller, but in different ways. For the seller, they get the interest, but they still have to perform, and it's on an annual basis versus an average. Versus for the seller, or versus for the buyer, they have to write checks along the way. And the biggest challenge with writing a check for an earnout in the interim period is, will your bank that's financing your deal let you do that? And it all ultimately depends on how you negotiate the level of leverage and your term sheet with your bank. So one final alternative earnout structure that we've seen, and this is mostly for, I would say, more strategic buyers that are focused on sales rather than profitability, like EBITDA or gross profit. So in this situation, say, for example, the business has a customer list, maybe some key customers, whatever the case is, and you want to tie the purchase price to those customers, continuing to be with the business. Now, if those customers leave, for example, or they decline, because you could even carve it out where, it's not all customers or all sales. It's really, I'm buying these 5 relationships. I want to make sure these 5 relationships stick around. You would define the bucket of customers that you expect, the target sales level for that customer, and then allow some sort of upside and downside to be paid out. So this is an example. It was a printing company that we sold in the past. I was bought by another printing company. They didn't care about the employees because most of them were let go. They didn't take on any of the equipment. They just bought the customer book and put the customers on their equipment. So they really cared about sales. That was the number one metric. So in this situation, the purchase price was 4.25, cash down to 3.5, and the earnout was 750,000 with 3 payments of 250,000 each over the next 3 years. The sales target for the customer book that they were buying was 2.825 million. Now, if sales on those specific customers either increased or decreased within a 5% threshold, then full payment is made, very similar to the actual 95% target threshold in the previous examples. But if sales increased or decreased more than 5% up or down, then the percentage increase, the actual dollar for dollar increase or decrease, 20% of that was applied against the earnout, either up or down. So let's just look at an example. So here they took the customer list of the historical in the last year prior to sale, and the total last 12-month customers totaled 2.825. Now, in the first year after the closing, the customers delivered 2.6, meaning they delivered less than what the target was. So in that situation, it was larger than the 5% threshold that was allowable. Therefore, the actual decline in sales was 225,000 between 2.8 and 2.6. So 20% of that decline is 45,000, and 45,000 was reduced on the first earnout period payment of 250. So instead of 250, 205 was paid in that period. In year 3, customers came back up and they delivered 2.8 million on that customer list relative to the target of 2.825. So here, very flat performance, therefore, no increase or decrease required, full earnout payment of 250 was made. And then the third year, the customers increased, there was price increases that were passed through and steady growth. And so they delivered 3 million on sales versus the target of 2.825, which is a 7.3 increase on customer sales, which is above the 5% threshold. Therefore, the 41,000 the 205,000 actual increase in sales, 20% of that was added on to the earnout. So the final earnout payment was 291,000 in year 3. So in this situation, partial decline, full payment, partial increase. But here, there's no focus on synergies or other new customers that came in through the door. It's really just, I bought those customers with the expectation that they would stick around. If they don't, you don't get paid for it. Doesn't matter what else comes in through the door. And so this is very rarely used by financial investors because logically it doesn't make sense to use it. Like, you want to mitigate your EBITDA risk and making sure that the business doesn't decline from that. But say, for example, you already own a business and you don't want to get into the hassle of calculating profit when you're going to put their customers within your P&L, well, then you can just carve out the customers specifically and do a sales target instead. Okay, so those are all different types of examples. Ultimately, if I were to summarize kind of the last few examples, the standard earnouts are very simple, but very one-sided in terms of the fact that either you miss it or you don't get it. Either you make it or you miss it, and then you don't get anything at all. Whereas, if you really want to structure a middle ground type agreement, a prorated structure is the way to go. And usually when sellers are represented by investment bankers, the investment banker will spot those risks and identify the need to structure prorated deals or upside features to make it more justifiable for the seller to accept that earnout and the risk that comes with that earnout. But let's go towards, why are earnouts in general seen as a bad thing? What happens? What are the common areas of conflict that come up? And the first thing we always recommend is that when you do structure a deal with an earnout, absolutely make sure you have an M&A advisor and or an M&A lawyer that has done these deals in the past so they can identify those common pitfalls so you're not exposed to it. But usually what ends up happening, the first one and the most common one that happens during conflict is how is the actual performance calculated versus the target. So a buyer and a seller agree, we're going to structure the deal tied to gross profit. If I deliver on gross profit of $1 million, great. Then at year end, The buyer prepares the financial statements and submits it to the seller, and the seller says, hold on a second, the way you calculated gross profit is different. I didn't move overhead rent and overhead costs into COGS. Those were below the line when I prepared the financial statements. So it's really important to define how those target benchmarks are actually calculated in the accounting statements. So I actually took up a recent example. This was from an LOI recently where there was an earnout. It was tied to the gross margin, and we specifically defined that gross margin would be calculated as all the business-related revenues minus the expenses that were historically categorized as cost of goods, including product costs, unrepaired costs, product cost, FX, delivery and freight. And then it excludes warehouse expenses, which is recategorized as an OPEX account for year-end purposes. So in this situation, their internal numbers had warehouse expenses in cost of goods, but the accountant at year-end took those out. So even though the internal statements may be prepared with warehouses expenses, we made it absolutely clear that, guys, this is how the accountant prepared it. We're basing it off of the accountant prepared numbers. Therefore, those are moved out. So the more detail on how you can define the target benchmark, the better, and the more likely you're going to avoid potential disputes in the future. The other one, and we kind of talked about it already, is from a buyer point of view, you may want to be aggressive with the seller and try to get a really good earnout. But that all or nothing type earnout, if they come in just under the target, as I mentioned, say for example, the target is $1 million in EBITDA and they deliver $999,999, well, the seller's going to feel like, come on, that's essentially $1 million bucks. So, why am I losing out on my entire earnout payment? That's why all or nothing earnouts usually drive conflict, whereas prorated earnouts, there's that chance to earn partial payment, which mitigates some of that dispute as well. The third one, and the one that we hear often from sellers when we first start talking about earnouts, is a lack of control. So in their eyes, they're going to look at a buyer and say, you're asking me to believe that you can transition this business, continue to grow it and maintain its performance, and I don't have no influence on my business anymore because I'm selling and I have to retire. Well, that feels really uncomfortable to me as a seller. How do I feel comfortable with that? And sometimes some sellers just can't get comfortable with that, and therefore they don't want to do earnout deals. And in other times, what we tell buyers is, bringing in a competent operator and demonstrating that you are going to lower the transition risk because of the team in place, the structure in place, your business plan in place to really start to mitigate some of those fears that the seller has. But the reality is that's never fully mitigated. Most sellers never really get over the fact that they have to take their hands off the wheel and trust another buyer with running their business and depending on them to deliver on performance to get the payment. That's just something that is always going to be there, and that's why usually earnouts are just less preferred from a seller point of view. Now, another area is financing future growth, and I've seen this in a few situations where the buyer strikes a deal, does the earnout, happy that they get the deal done, close it, and then a year later, the business continues to grow and the earnout and the upside feature captures that increase in the purchase price. But then they come back to the table and they're like, you know what? I actually don't want to pay the upside because, hey, hold on a second. I had to invest in CapEx. I had to add new staff. I had to make all these other investments, which really net, I'm not actually coming out ahead right now because I have to also pay you because you didn't incur those costs. So sometimes that does come up, and that's why buyers are going to push for EBITDA as a target because that captures a lot more of the costs versus a seller is going to say, well, hold on a second, you're making long-term investments in the business that are permanently adding value. So even though, yes, on a one-year basis, you may be coming up short, I am only going to capture 1 year of profit from that earnout versus you're going to capture the perpetual profit that comes with that growth. So it's one of those constant kind of balancing acts of, as a buyer, just make sure you're pricing in the cost of growth, especially if you have an earnout with increasing milestones. Yeah, if those milestones are increasing, then you also have to factor in the cost of growth and who's paying for that growth, and it's usually the buyer. The other one is, and this is very common with the management teams. So say, for example, a business sells, minority shareholders in the business are the middle managers that also have earnouts tied to them sticking around. Now, the buyer is going to come in and say, I really want to invest in the business. I want to grow it. I want to add IT assets and upgrade the ERP, invest in marketing, really juice up the returns so that I can build the business, bring fresh energy to grow it. But the challenge is for people that are still in the business or for the seller that has the earnout that's tied to EBITDA, well, all of those costs are going to hit EBITDA and lower EBITDA. So there's this internal resistance. If the seller or the middle management team that has the earnout, if they're still in the business, there's this friction that comes up where they want to hold off on major expenses until the earnout's fully paid out so that the EBITDA isn't hit. So in that situation, either you need to change the EBITDA target from you change the metric from EBITDA up to gross profit, or define that growth costs are excluded from EBITDA, and therefore the sellers and the team that's staying on are less resistant to that change in terms of increased costs. But this is one that I've seen countless times where especially the seller that stays on for 2 years to transition the business, they're constantly grumbling and hemming and hawing that, like the way it was done is perfectly fine. Don't try to reinvent the wheel. Why are you incurring all these costs? And the buyer's like, well, you're poo-pooing all my new ideas. Why is that? Well, there's a financial incentive for the seller to resist those costs. So it's important to really align incentives. And then the last one, and this is always the pain in the ass for most buyers, is the bank. And it's so important when you're structuring an earnout that you have to run the earnout and the projections by the bank. But walk through a down case scenario and help the bank understand, when am I allowed to make a payment versus when I'm not allowed. Because the bank is always going to reserve the right to block an earnout payment, because the earnout is going to be subordinated and postponed to the bank debt. So if, say, for example, the business delivers on flat performance and you promise in the earnout an interest payment and maybe some sort of earnout payment, well, if the bank blocks that, that causes immediate friction, because then the seller is going to be like, oh, I don't want to hear about the bank. You own this business, you have money, you promise you're going to pay me. We delivered on the target. Why aren't you paying me? And so obviously sometimes the banks don't understand this because they're not in the room. But from a buyer-seller relationship management point of view, it's important to understand that either factor into your projections that additional payment, layer of payment, or make sure that you have enough money at the end of the year to make that payment. Because the bank postponing an earnout payment is like the lowest and worst excuse you can use with a seller. You can scream that from the top of every single mountain. A seller will never understand that. They will simply say, you bought my business, you're responsible to pay me. I don't care whether it's the bank or you owe me my money. And that creates a lot of conflict. So now, kind of putting my hat on from the seller point of view, one of the common questions I get is, well, how do I know if my earnout's safe? What sort of protections do I have in place? And so the most common earnout security term agreements and protections for a seller, the first one is the general security agreement, which is essentially a charge on the business. So your lawyer, the seller's lawyer, is going to register a subordinated charge against the operating company, and it will be only subordinated to the bank's GSA charge. So meaning in a situation where the bank calls that loan, you will still have a charge on the business. And usually the bank, the first call they make when a deal goes sour with a buyer is the seller, to ask them, are you willing to buy the business back, to take the business back and turn it around? And that's why you always hear of those stories where a business owner sold their business and bought it back for 10 cents on the dollar because the buyer couldn't make it work, and the bank was like, help us, take us out of this problem. You know it best because you were the owner of the business previously. So a GSA charge is really a good foot in the door to always make sure that you're in there. Even if things go sour, you have that charge, and you have to cooperate and work together with the bank. The other one is a pledge of shares. So similarly, the bank is going to ask for a pledge of shares as a senior debt lender, but you can ask for a secondary charge on the shares, meaning the bank and you have to cooperate and continue to work together in a down case scenario where the business goes down. Now, in certain instances, the third one is I've seen personal guarantees. I think this is rare It's very rare in Canada. Sometimes, you will see it in certain deals where, the buyer really has a strong relationship with the seller, and essentially is willing to accept the risk that comes with the personal guarantee. But if the seller is really, really nervous, sometimes they will insist, hey, listen, give me even a partial guarantee 20% of the earnout or something like that, where, in a situation where the buyer buys the business, they owe money on the earnout and they choose not to pay, or they try to shift funds and run away from payment, the personal guarantee is that nuclear option for the seller. But just to manage your expectations, if you're a seller listening to this video, I would say it's very rare. I've done probably 40 transactions in the last couple of years, and I've seen it in one deal where there was a personal guarantee on an earnout. And the only reason why it was there was that it was actually a charge on a holding company, a personal holding company that had personal wealth. It wasn't even a personal guarantee, but it was a charge from another holding company. Now, another security element is the covenants. So very similar to a vendor note, there could be covenants in the Earnout security document where you would limit the new owner's ability to pay dividends or excess bonuses. You would require the new owner to provide quarterly and annual financial statements, and you would limit the amount of debt that they could put on the business. The funny part is the bank is going to do this anyways for you. They're going to enforce these covenants from the bank's point of view, but to add that second layer of protection to make sure, hey, listen, even if they pay out the bank debt, I just want to make sure, so long as I have money outstanding, I don't want to see you guys taking out millions of dollars in dividends. I need to make sure my money gets paid out first. So that's a very common security element to most earnout and VTB agreements. And then the last one is the change of control. So and this would really only apply like for a 1 or 2 year earnout, it's less so. It's not really that important, or it doesn't really have a lot of power to it. But say, for example, you have some sort of royalty agreement or longer term earnout, which again is rare, but you see it sometimes. Or maybe the earnout is 3 to 5 years out. In that situation, that's a long time to wait for that money to be paid. And so there's always the potential that business, the new business owner, may simply just flip the business, may buy the business, and 2 years down the line realize, you know what, I want to get the hell out of this thing. I'm selling it myself. So what we always recommend, especially for the seller's lawyers, add in a change of control clause, which from a seller's point of view, if a buyer sells that business, you have no relationship with their buyer, right? Because by then you're out of the business, you weren't in those negotiations. You should not be responsible for collecting money from someone that you have not worked with or built a relationship with. So if the business sells, then simply the earnout is fully paid out in full upfront using the purchase price proceeds, which eliminates the risk of you hanging around as a subordinated, creditor on someone else's deal. So overall, when you kind of look at the elements of the pros and cons of an earnout, I would say, again, it's one of the more less common types of seller financing. In most of our deals, we lean towards the vendor note more than the earnout, but sometimes it's required, especially for those types of run-ups in performance where the seller really wants to value maximize. So really from a pro point of view, the ability to realize a higher valuation is the number one element that, we always say, if you really want to value maximize, the earnout's the way to go. And as well, from a buyer point of view, if you're willing to accept an earnout, that means you're willing to share risk with that buyer, to share in the future performance risk. You have skin in the game, and that ultimately attracts buyers. Because from a buyer's point of view, one of the challenges is, say, for example, your business runs up in performance, and you quickly say, I'm never interested in accepting an earnout. Well, then there's probably not going to be a lot of buyers for your business. Versus if you have reasonable expectations and you want to sell and you're open to an earnout, the more buyers are open to working with you and trying to structure a deal to get it done. The other one is the legal risk mitigation. So an earnout can also be used as a post-close purchase price adjustment. Meaning if there are any lawsuits or claims on unpaid situations, from a buyer's point of view, there's money that's outstanding there that you can go after that offers some sort of protection for you as the buyer. So there is legal risk mitigation, which comes with any sort of seller financing. And then what I always, communicate to the seller is that ultimately an earnout is kind of like a bit of a lottery ticket. There's some uncertainty, and probably the risk level is a lot better than a lottery ticket. But at the end of the day, don't bank on the earnout to really get the payout that you want. It should be more of a value, the ability to capture extra value rather than the core value. So the way I communicate is that an earnout is really that extra value potential in capturing that ultra upside, especially if you can have an upside feature to that earnout. Now, on the flip side, we've already kind of talked about this. The lack of seller control is a big thing. Most sellers resist that and never really get fully comfortable with that. The short-term versus long-term interests are always going to be create friction, especially in situations where the seller or the middle management team that are tied to that earnout are working in the business post-deal. There's going to be that friction between the short and long-term interests. The other risk from a seller point of view is the manipulation risk, especially if you weren't advised correctly and you accepted an earnout where it was based on EBITDA only with no definitions around growth costs and costs that should be excluded. A buyer could increase costs and drive down the actual EBITDA in the short term to really miss targets and not pay out the earnout. So there is that risk, but with a proper team around you, and if you structure that deal correctly, that risk should be mitigated. Now, in terms of higher closing costs, that is another con. Ultimately, earnouts are just a little bit more messier. A vendor note is pretty simple. There's an interest rate, there's a term behind it. It's like a loan. With an earnout, there's all these hypotheticals. What if this happens? What if that happens? X, Y, and Z, and you have to analyze scenarios a lot more in depth, which ultimately creates more cost in terms of papering the agreements with the lawyers. So just realize that if you want like a very simple agreement, an earnout is not the way to go. And there are certain buyers that we deal with that simply say, no, we will not look at earnout type deals because of the complexity behind it. And we just don't want to get involved with that kind of stuff. And then lastly, seeing that I'm Canadian, in Canada, the challenge with an earnout is that, if you wait to pay the tax on that earnout in the future, it's taxed at an income rate rather than a capital gains rate. So either you prepay the tax on the earnout up front, which means you're paying tax on a future payment that you may not receive and is subject to future performance, or you wait on that payment to be delivered, but then you're taxed at a higher tax rate. So it's a little bit, it's kind of like you get in the short end of the stick on the tax side versus, for example, a vendor note. Vendor notes are fixed, secure, you're going to get them. So you can prepay the tax knowing that you're going to get the money on the back end versus here, you may prepay the tax and you can recoup the tax on the back end, but you may not be able to receive the money for it. So that performance risk is always there. So hopefully that answers and gives you a really good overview of kind of the earnouts in M&A. Like there's a lot of detail. Ultimately, I think there's a lot of myths and misconceptions about earnouts. I think they play a valuable role in the M&A markets, but at the same time, if you don't have a competent team around you, they can get really tricky, really complicated, and ultimately create a lot of friction between the buyer and the seller. So again, if you have any questions, please do feel free to reach out to me over LinkedIn or send me an email. And also please consider just visiting our Finance Kid website to sign up for our newsletter and just check out more M&A videos on our YouTube channel. There's a lot out there. So I appreciate you watching and have a great day, guys. Thanks.